Good afternoon, folks. We head into US trade on Tuesday, the 28th of November. We'll flick across the headlines as per usual, and then we'll jump over to some charts now in a minute. But not much really in the way of fresh headlines, apart from something to do with oil. We'll speak about oil when we get around to a chart in a minute. Had a bit of volatility about an hour ago, maybe about half an hour ago. Bit of downside, bit of upside to do with a delay in the OPEC meeting, but apart from that, it just seemingly as if the US dollar is continuing to being sold back into, which is obviously what we suggested today, yesterday, and have been for a while now. Each time the dollar pops higher, it seems to get sold back into for reasons that we have suggested. The Fed do seem as if they're done with interest rate hikes, and economic data does seem to reaffirm that as well. We've had some housing figures out over the last 5 or 10 minutes suggesting that is again the case, both missing consensus. So that then causes a bit of downside in stocks. Yields are choppy in today's session, but you can have a flick across the headlines here. I mean, not exactly too much in the way of fresh news. ECB officials dampened expectations of interest rate cuts next year, so they do seemingly want to push back on that. All central banks will want to push back on that, but I think markets kind of make up their own opinions rather than what the central bankers seem to say these days. But apart from that, you can see from this morning until now, should I say, not much in the way of fresh drivers of price action. You can see stock indexes down across the board in the US, but as you can see, the percentage change of them minus 0.16 is the biggest. So not really a lot to see there in terms of US equity futures, but in terms of European equities, downside in line with those ECB officials suggesting we will not get rate cuts next year. Obviously, they're going to say that, but that causes a bit of downside in European stocks. Asia Pacific stocks mixed, nothing to see there. Commodities, oil is now slightly back higher. We'll talk about oil in a minute when we get around to a chart, but yields in the US positive today, but they are just choppy. They just happen to be above where they opened overnight. US dollar has taken a turn for the worst in the past few hours. A bit of a bounce back, bit of a push higher, and the US dollar sold back into, as I said, but you'll see that when we get around to some charts in a minute. The Australian dollar minutes last week from Australia did suggest potential for one or two more hikes, which again we did allude to, and again remember it proves to be supported, even in line with stock indexes mostly lower, albeit by not that much of a distance. But you can see Aussie, Kiwi, Euro and Sterling beginning to push higher again. Euro helped with comments from ECB officials pushing back on interest rate cuts from next year, which is it's not exactly hawkish, but it's a bit of a hawkish comment, which helps the euro continue to push higher, which also helps the US dollar to continue to push lower. But you saw in the overnight session a bit of a pullback in your Aussie, Kiwi, Euro and Sterling. That has then been dips have been bought in those four currency pairs, and then you see the dollar pairs, dollar Swiss, dollar CAD, dollar yen, bit of a bounce back again, sold back into the same thing in the dollar index. So it's likely to be the team going forward. The S&P 500, the Dow Jones, the Nasdaq, the Russell, all just choppy, not doing too much. Don't really want to push higher, but they also don't really want to push lower. The prospect of rate cuts potentially from the US. Market participants think rapid rate cuts from the US next year, likely to keep stocks supported. But as we said before, rates are cut for a reason. That reason is not positive for stock indexes. The DAX pushes lower, but it's been choppy as anything today. Euro stocks pushed lower at the open, just before the open, in line with those comments from ECB officials. You can see yields bit all over the place. US, the 2-year, after some strong aggressive downside yesterday, don't really know what they want to do. Gold continues to push higher, which is to be expected with the prospect of the US being finished with rate cuts. That is something that gold likes, and being finished with rate hikes, should I say, is something that gold likes. And then the prospect of rate cuts into next year, again, something that gold likes. But oil, a bit all over the place in the last kind of hour or two. You can see quarter past one, that's a 5-minute chart. The quarter past one candle, aggressive downside. Now you have bounced back, but I was a little bit confused when I read the headline initially. I mean, on one hand you've got OPEC struggling to come to some sort of an agreement, and there's rumours then from Reuters cited sourced their sources or from Reuters sources, should I say, which is obviously people got links to OPEC and journalists in the industry that did suggest that OPEC were looking at pushing back that meeting for a further week. Again, that shows that there's clearly a pushback. I mentioned those African nations from the other day, seemingly reluctant to increase cuts to production or to extend cuts to production. That is then a reason for downside in oil, but on the flip side, they're trying to push it back to probably come to some sort of agreement on the cutting of production. So you saw a bit of downside that was then reversed completely straight away, and you just kind of met back at the starting point really. But I mean, on one hand, pushing back the meeting probably just delays the inevitable in my point of view. They'll probably just come to some sort of an agreement on how much to cut production by. If they do come out and cut production again, either way, if they extend production cuts or even do they cut production and then extend that further past year end, which was the original agreement. So they probably will come to some sort of agreement, maybe back end of this week into next week. That's probably likely to result in some sort of cut or an extension to cuts on production, which should, in theory, drive the price of oil higher. But gold higher, in line with dollar weakness, in line with the rate, the interest rate situation. Big downside in yields supporting for gold. US dollar rally being sold back into equities, not doing too much at the moment. So it'll be interesting how they wake up, or how the US wake up at 2:30. It's really their first kind of full trading day since the Thanksgiving holiday. So we'll have to see how that plays out at 2:30. Yesterday, I'd have to imagine there was a decent chunk of market participants not active within the S&P 500 yesterday, which is relayed in charts. I mean, it just did nothing all day there. Well, the majority of the day. Bit of downside overnight, bit of upside, just met back in the middle, and stocks have been all over the place really since Wednesday of last week, which is unsurprising given the holidays in the US. So the bias remains the same. US dollar weakness, stocks a little bit tricky, yield weakness, gold higher. Probably purchase bonds, purchase gold, and sell the US dollar. Then some home price figures. You can see previous 0.3, actual 0.2, so down slightly in the previous. No consensus across this calendar, but the forecast from Trading Economics itself 0.3, which theirs was 2.5 for this, so maybe it's not worth reading into it too much. But previous 2.1% missed consensus again, and okay, it's a bit of an increase on the month of August into the month of September, certainly in terms of the S&P's version of calculating home prices in the US. But with that being below consensus again, it's another print that misses consensus, albeit a medium impact, but again misses consensus. The figures from yesterday have missed consensus since the Fed have been out. Or the last NFP we got missed consensus, the last unemployment rate ticked higher, CPI, PPI, all of these numbers are missing consensus. You had durable goods orders last week in the US missing consensus, so you're just getting misses across the board on any US data point you look at, and that continues to be a driver for US dollar downside to come. We'll get some GDP figures from the US tomorrow. That is the second estimate of Q3, so it's a backwards looking indicator, so maybe we will not get much volatility off the back of that. But then into Thursday, where there is PCE from the US, which certainly will be something that has the potential to keep the US dollar going lower if that misses consensus. So the bias stays the same: short dollars, long gold, long bonds. Same probably the way to play it, certainly until we get to inflation on Thursday.